Welcome back to this week's edition of the Risk Spotlight Operational Risk News Update. My name is Emily Jones, and today I'll bring you essential updates and insights from the world of operational risk. All information is sourced from the RiskSpotlight Portal, the premier forward-looking service for operational risk content. Let's get started. First up, the latest State of Global Cybersecurity 2025 report from Checkpoint Software highlights a 44% surge in cyber attacks worldwide over the past year. Particularly concerning is the role of generative AI, which has been weaponized for disinformation campaigns, deepfakes, and facilitating financial theft. The report also flagged a significant increase in ransomware and information stealer attacks. With 96% of successful exploits based on known vulnerabilities, proactive patch management and securing edge devices are critical. Chief Information Security Officers are encouraged to adopt AI-driven threat intelligence and strengthen BYOD policies to counter these evolving risks. Transitioning to a broader risk landscape, the Forvis Mazars annual risk assessment reveals that geopolitical tensions, financial crime, cyber threats, and climate risks top the list of concerns for financial services firms globally. Political instability, including conflicts in the Middle East, continues to disrupt markets, while financial crime is growing alarmingly, with illicit funds exceeding £3.1 trillion in 2024. Cyber threats remain pervasive, as the EU's Digital Operational Resilience Act DORA comes into effect this year, placing additional regulatory demands on firms. Meanwhile, climate risks have become a financial burden, with extreme weather events causing insured losses of around £250 billion annually. The report calls for strong leadership to embed risk management into daily operations, preparing firms to navigate this intricate and dynamic risk environment effectively. Now, turning to the UK, a new era of consumer protection in payments has begun with the introduction of the Authorized Push Payment (APP) fraud reimbursement scheme. Effective from October 2024, this scheme mandates payment service providers to reimburse victims of AP fraud, sharing costs equally between sending and receiving institutions. While the maximum reimbursement is capped at £85,000, exceptions apply to vulnerable customers, ensuring they are fully protected. The payment systems regulator highlighted that AP fraud accounted for 40% of fraud losses in 2022, making this a critical step in enhancing consumer safeguards. Firms must comply with standards such as prompt investigation and reporting of claims while ensuring support for victims. On the topic of ransomware, the UK government is considering a ban on ransomware payments for critical industries and public sector bodies. This proposal aims to reduce financial incentives for criminals and strengthen national cybersecurity. Under the proposed legislation, organizations would also be required to report ransomware incidents within 72 hours. While the initiative is seen as a bold move to protect essential services, concerns have been raised about its potential impact on small businesses and non-critical sectors. Proposed measures also align with global trends in combating ransomware, aiming to disrupt the financial lifelines of cybercriminal groups and improve national cyber resilience. Now, let's talk about artificial intelligence and its growing influence in financial services. The U.S. Securities and Exchange Commission, SEC, is sharpening its focus on AI-related disclosures, emphasizing the need for companies to accurately describe their use of AI in operations, strategy, and risk management. Key expectations include clarifying how AI is applied, who developed the technology, and identifying potential risks such as algorithmic bias or dependency on third-party providers. Misleading claims, like overstating AI capabilities, have led to recent enforcement actions against companies such as Global Predictions and Delphia. These cases serve as stark reminders for firms to ensure their AI-related communications are transparent and substantiated. Companies are urged to adopt a proactive approach to AI disclosures, contextualizing details, highlighting material risks, and avoiding speculative claims. Talking about the AI regulatory landscape, in the absence of federal AI regulation in the U.S., several states have enacted or proposed laws to mitigate algorithmic discrimination in employment decisions. Algorithmic discrimination refers to differential treatment based on protected characteristics, often caused by flawed AI training data. States like Colorado, Illinois, and New York have implemented laws requiring employers to assess AI systems for bias, notify employees about AI usage, and conduct audits. Colorado's AI Act, effective in 2026, mandates risk management policies, while Illinois prohibits discriminatory AI usage. New York City's Local Law 144 enforces annual bias audits and penalties for noncompliance. California has proposed AI rules under the CCPA and Civil Rights Council regulations to ensure transparency and anti-bias measures. Texas's pending bill outlines stricter requirements for high-risk AI systems. Employers must stay updated on this patchwork of laws, implement transparency measures, and conduct proactive audits to address bias risks and ensure compliance. Let's pivot to data privacy in U.S., where the Department of Justice, DOJ, has announced new rules governing data transfers to countries like China and Russia. Under the Data Security Rule, companies must implement stringent cybersecurity controls for transferring sensitive personal data to designated countries of concern. This regulation aims to mitigate national security risks associated with cross-border data flows and will come into effect in April 2025. Notable exemptions exist for financial services transactions, but organizations must still demonstrate compliance through regular audits and robust security measures. Lastly, the cryptocurrency space faces a new threat: transaction simulation spoofing. This attack exploits a feature in Web3 wallets designed to preview blockchain transactions. By manipulating on-chain contract states during the simulation execution gap, attackers have stolen assets worth hundreds of thousands of dollars. Caution should be exercised when interacting with unverified platforms, and wallet providers should update simulation refresh intervals to counteract this vulnerability. Now, let's turn to key operational risk loss events reported last week. The first update is about American Express agreeing to pay approximately $230 million to settle U.S. criminal and civil probes into alleged deceptive sales practices. The settlement includes a $108.7 million civil payment to the Justice Department and a separate non-prosecution agreement with the U.S. Attorney's Office for the Eastern District of New York. The allegations involve misleading marketing of credit cards and wire transfer products to small business customers from 2014 to 2021, including misrepresenting card rewards, fees, and tax benefits. American Express was accused of using dummy employer identification numbers and submitting falsified financial information for potential clients. The bank stated that it cooperated extensively with regulators, took corrective actions, and had already allocated and reported the costs associated with the settlement in previous financial periods. The next update is about Block Inc., the parent company of Cash App, agreeing to pay an $80 million fine to 48 U.S. state financial regulators for violating anti-money laundering laws. The settlement addresses insufficient policies for policing money laundering risks on the Cash App platform, which has over 50 million users. As part of the agreement, Block will hire an independent consultant to review its Bank Secrecy Act and anti-money laundering program and report any deficiencies to regulators. The next update is about BitMEX. A federal judge ordered BitMEX's parent company, HDR Global Trading Limited, to pay a $100 million fine and serve 2 years of unsupervised probation for violating the U.S. Bank Secrecy Act. The cryptocurrency exchange was found to have operated without a meaningful anti-money laundering program, allowing users to open accounts with only email addresses and neglecting proper Know Your Customer procedures. The next update is about MasterCard agreeing to pay $26 million to settle a proposed class action lawsuit alleging pay discrimination against female, Black, and Hispanic employees. The settlement covers approximately 7,500 workers who claim they were underpaid compared to their male and white counterparts since 2016. As part of the agreement, MasterCard will conduct annual pay equity audits for 3 years and hire a psychologist to evaluate its career framework, although the company denies any wrongdoing. That concludes this week's operational risk updates. For more on these topics and additional insights, visit the RiskSpotlight Portal. If you're a subscriber, log in or go to riskspotlight.com to sign up for a free trial. Thanks for tuning in, and until next time, stay safe and keep those risks in check.